Ever wonder how some people manage to make money in the stock market even during bubbles and corrections? Let's delve into the world of stock market volatility. The stock market is a dynamic entity, constantly fluctuating in response to a myriad of factors. This constant ebb and flow of prices is what we refer to as volatility. It's like a great, unpredictable sea of opportunity. Now, within this sea, we have two prominent phenomena: bubbles and corrections. A bubble occurs when prices of securities significantly exceed their intrinsic values, driven by exuberant market behavior. It's like a party that's gotten out of hand, and we all know what follows a wild party: a major cleanup. This cleanup in the stock market is what we call a correction. A correction is a decline of 10% or more in the price of a security from its most recent peak. So, how can one navigate this volatile sea to make a profit? That's what we're going to explore today. To make money in any market condition, you first need to understand the market cycle. Just like the seasons of the year, the market cycle has its own distinct periods, each with its own unique characteristics. Let's begin with the first phase, accumulation. This is the winter of the market cycle, a time when savvy investors start to notice undervalued stocks. The market might be cold and uninviting, but these investors see beyond the frosty exterior, recognizing the potential for growth. Next, as we move into spring, we enter the markup phase. Just as the world comes alive in spring, so too does the market. Prices begin to rise and more investors jump on board, fueling the growth even further. This is usually the longest phase of the market cycle, and it's where bubbles can start to form. Then comes summer, the distribution phase. This is when the early birds who accumulated in the winter start to sell off their stocks. They're distributing their shares to the latecomers, those who are just now hopping on the bandwagon. If the sell-off is too great, this can lead to a market correction, a drop of at least 10% from the market's peak. Finally, we have autumn, the markdown phase. The leaves are falling and so are the stock prices. Those latecomers who bought in during the distribution phase are now selling off their stocks in a panic, causing prices to plummet even further. But here's the thing, just as winter gives way to spring, so too does the markdown phase give way to another accumulation phase. The cycle continues over and over again, and understanding these phases, recognizing the signs of each one, can help you navigate the market's ups and downs. Knowing when to buy, when to hold, when to sell, these decisions all hinge on your understanding of the market cycle. So whether you're facing a bubble, a correction, or any other market condition, understanding the cycle is key. Knowing where we stand in the market cycle can provide invaluable insights into potential investment strategies. One of the simplest strategies to profit in any market condition is the buy and hold strategy. Let's delve into what this means. Simply put, buy and hold is all about purchasing stocks and keeping them for an extended period, regardless of the market's ups and downs. It's about playing the long game, banking on the fact that over time the value of good stocks generally increases. This strategy has its advantages. For one, it's straightforward and doesn't require constant market monitoring. It also sidesteps the stress of trying to time the market, an endeavor that even seasoned investors find challenging. However, buy and hold is not without its drawbacks. It requires a lot of patience and a strong stomach to weather market volatility. It also necessitates careful selection of stocks, as not all will perform well in the long run. Despite these challenges, buy and hold can be an effective strategy, particularly in a volatile market. It's all about resilience and long-term vision. The buy and hold strategy requires patience, but it can be a sound approach in a fluctuating market. For those who like to take a bit more risk, short selling can be an effective strategy. Picture this. You're at a party and someone hands you a bottle of wine. You don't like the wine, so you sell it to someone else at the party for $20. Later in the evening, you see the same wine being sold for $10. You buy it back, pocketing the $10 difference. That's the basic idea of short selling. But let's translate this to the stock market. Short selling is a strategy where you borrow shares of a stock you believe will decrease in value. You sell those shares at the current market price, hoping to buy them back later at a lower cost. The difference between the price you sold at and the price you bought back at is your profit. However, it's not as easy as it sounds. The stock market is unpredictable and prices don't always go the way we anticipate. If the prices rise instead of falling, you're still obligated to buy back the shares to return them. This could lead to substantial losses. That's why short selling is considered a high-risk strategy. it's not for everyone. But for those who have a good understanding of market trends and risk management, it can be a profitable venture during market corrections or crashes. When the market is on a downward trend or in a bear market, as it's commonly called, investors who have gone short can make profits while others are making losses. It's a way to capitalize on market volatility and downturns, and it's used by many experienced investors and traders around the world. However, it's crucial to remember that short selling involves a high level of risk. It requires a keen understanding of the market trend and a strong strategy for risk management. Without these, the losses can quickly add up. Remember, short selling can be risky, but if done correctly, it can offer substantial returns during market downturns. Another strategy for navigating market volatility is diversification. Now, diversification isn't just a fancy word tossed around in financial circles. It's a crucial strategy that can help protect your investments against losses and provide opportunities for gains even in turbulent market conditions. Think of diversification like a balanced diet. You wouldn't eat just one type of food every day, would you? No, because you want to ensure your body gets a variety of nutrients. Similarly, you don't want to invest all your money in one type of asset or in one sector. Instead, you want a mix of different assets that can react differently to the same economic event. This strategy can help cushion your portfolio against major losses. Imagine you have all your investments in technology stocks. If the tech industry takes a hit, so does your entire portfolio. But if you had diversified and also invested in, say, healthcare and utilities, the losses in technology might be offset by gains in these sectors. Diversifying isn't just about spreading your investments across different sectors. It's also about spreading them across different asset classes like stocks, bonds, and commodities. Each asset class reacts differently to market conditions. When stocks are down, bonds might be up. So, a diversified portfolio can help balance out these fluctuations. Moreover, it's important to consider geographical diversification. Investing in different countries or regions can provide exposure to various economic cycles and opportunities. If one country's economy is underperforming, another may be thriving, helping to balance out your returns. However, remember that diversification isn't a guarantee against loss. It's a strategy to manage risk and potentially improve returns. It's like wearing a seatbelt. The seatbelt doesn't prevent accidents, but it can help protect you if an accident occurs. In conclusion, don't put all your eggs in one basket. Spread them out. By diversifying your portfolio, you're not just betting on one player, but the entire team. And when the team wins, so do you. Diversification can help you weather the storm of market volatility and potentially come out ahead. So there you have it, 3 strategies to make money in the stock market, even during bubbles and corrections. Firstly, we explored the concept of buying and holding. This is a long-term strategy where you invest in companies you believe in, and then you sit tight through the ups and downs. It's all about patience and conviction in your choices. Remember, it's not about timing the market, it's about time in the market. Then we delved into the world of short selling. This is a more advanced strategy that involves betting against a stock. When the market is experiencing a downturn, or when a company's fortunes seem to be on the wane, this can be a profitable approach. But it's essential to note that this strategy requires a lot of research, experience, and a certain level of risk tolerance. And finally, we discussed diversification. Never put all your eggs in one basket. Spreading your investments across different sectors, geographic locations, and asset types can help to mitigate risk and enhance potential returns. It's about creating a balanced and diverse portfolio that can weather the storms and capitalize on opportunities. Throughout all of these strategies, understanding the market cycle is key. Recognizing the signs of a bubble or a correction and knowing how to respond is vital. It's about being able to discern when the market is overvalued and when it's undervalued. And remember, it's not just about market trends. External factors such as political events or economic indicators can also influence the market. In conclusion, the stock market may seem like a daunting place, particularly during periods of volatility. But with these strategies and a solid understanding of the market cycle, you can turn these challenges into opportunities. Remember, the stock market is a sea of opportunity, even in its most turbulent times. With the right strategies, you can navigate the waves and make a profit. Thanks for watching, and we'll see you next time.